Right now, institutional capital is draining out of traditional banking pillars and pouring straight into decentralized blockchain networks. The trigger for this exodus is the Digital Asset Market Clarity Act. This legislation gave virtual asset service providers, VASPs, a formal playbook to bypass legacy banks and offer yield-bearing digital asset accounts directly to the public. This quadrant chart maps trade-offs. Bottom left, legacy checking offers low yield and high friction. Top right, VASP accounts deliver high yield and instant speed. But moving funds across public chains introduces variable systemic risk, stripping away federal deposit insurance. Commercial banks rely on deposits to fund loans and keep credit markets moving. When billions of dollars leave checking accounts for stablecoin yields, Wall Street faces a liquidity drain that threatens the industry's ability to provide credit. Wall Street incumbents are watching their foundational deposit base erode to agile tech startups. The legacy banking sector's official stance is aggressive resistance. Industry leaders like Jamie Dimon have publicly declared they will actively fight this VASP invasion. If you manage a corporate treasury, this leaves you with a tough decision today. Do you migrate billions onto risky VASP rails to capture speed and yield right now? Or do you wait for legacy banks to build a safer alternative? The banking sector is answering that question by operating on two fronts. They are fighting the clarity legislation in Washington, and they are engineering a regulated 24/7 ledger designed to capture and hold institutional dollars. This bank-led infrastructure is being built by a coalition of legacy giants called the Clearinghouse. They've announced a unified tokenized deposit network scheduled to launch in the first half of 2027. Their strategy is straightforward: absorb crypto's best feature, instant 24/7 settlement, and rebuild it entirely inside a heavily regulated perimeter. This table compares architectures. First, VASPs offer protocol-backed yield, whereas TCH relies on commercial bank interest. Second, VASPs operate on open blockchains, while TradFi uses a private bank-gated ledger. Third, VASPs have clarity compliance. TCH operates under a Federal Reserve Charter. The 2027 network forces a strict trade-off. Corporate users secure institutional-grade safety and zero counterparty risk, but they forfeit the borderless, permissionless freedom of decentralized finance. To understand why institutions prefer the bank's option, we need to look under the hood. A standard VASP stablecoin is a liability of a crypto issuer, theoretically backed by off-chain reserves. A tokenized deposit is your actual FDIC-backed commercial bank balance, simply wrapped in a digital format so it can move quickly across a ledger. When initiating a transfer, physical fiat morphs into a digital token, settles at warp speed across the network, and instantly reverts back to standard fiat. Corporate treasurers get to execute blockchain-speed settlements without ever pulling their capital off the heavily audited balance sheets of banks like JP Morgan or Citi. Speed is great, but crypto's true technological moat has always been programmability, the ability to embed conditional smart contracts directly into the money itself. The primary goal of the 2027 TCH network is to graft that exact programmability onto legacy institutional dollars. For corporations, this means the ability to write code that automatically releases escrow, instantly withholds tax, or pays cross-border vendors at 3 a.m. on a Sunday. This creates a strategic challenge for tech platforms. Once legacy banks offer programmable money inside a compliant environment, VASPs lose their unique utility advantage and are forced to compete purely on yield. By matching the technology natively, traditional finance eliminates the friction points that drove the global corporations that underpin the deposit market toward crypto in the first place. But the banks aren't relying on technology alone. They are aggressively lobbying Washington to rewrite the rules of engagement. TradFi has issued a regulatory ultimatum. To hold deposits and offer yield, tech VASPs must endure the exact same federal oversight as legacy banks. Securing a full banking charter is an arduous process. It requires surviving punishing Fed oversight, meeting strict capital reserve ratios, and enduring relentless federal audits. Most tech startups simply lack the capital structure and the operational stomach to survive the transition into a heavily regulated commercial bank. By simultaneously raising the technological standard and weaponizing regulatory hurdles, traditional finance is actively suffocating smaller innovators to reconsolidate its control over institutional capital. So, which system should you build on? The choice between the open ledger and the walled garden depends entirely on your primary capital directive. This decision tree maps your financial priority. Corporate treasurers prioritizing capital preservation should wait for the 2027 TradFi network, accepting lower yield for zero counterparty risk. Fintech operators seeking open access should leverage stablecoins, accepting the continuous regulatory friction. Just remember, if you choose the open ledger, you are stepping into a hostile environment where traditional banks will actively try to block your access to institutional capital. The infrastructure of global value is transitioning on-chain, but the legacy gatekeepers have adapted, ensuring that the future of institutional finance remains a highly regulated, tightly controlled walled garden.